Welcome to This Week in Money. I'm Jim Goddard. Today, Bo Polny from Gold2020Forecast.com believes the Hong Kong stock market is about to collapse. CanadianInsider.com's Ted Dixon thinks investors are moving to growth stocks from defensive investments. And Tim Cyclesman Wood says crude falling into the $30 range is still realistic. We'll talk to Bo Polny right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Bo Polny of Gold2020Forecast.com. Welcome to the show, Bo.
Hi, Jim. Thank you so much.
The U.S. dollar has been on a rampage, it seems, for the last year or two. You made some predictions about it. The last time we talked, you said the U.S. dollar was expected to bounce, and that happened. What's going to happen with the U.S. dollar now and into the future?
Jim, looking at the dollar, I think last time we had spoken, I was looking for a short-term bounce back up into 100, and we got that. Dollar bounced from our, I think, the 6th of April, early part of April interview, went up into the 13th of April, topped out at 100, and then since dropped, and even today is down another 40, so it's like in the 97 range, 96.5 or so range. So short-term forecast for the dollar is again another bounce. I expect the dollar to be bouncing here. This should potentially, on a short-term cycle, could be a cycle low. We should see a short-term rally back up. But again, as we spoke over the past couple of interviews, I'm still looking at, right now, the Ides of March, or the middle part of March, around the 15th, at, I think it was 100.71. The cycles still show that to be a solid top. And regardless of what happens here in the short term on a bounce, even if that top is touched or whatever it does, it's still not going to be enough because the cycles are going to turn back down for the dollar. And just as I'd forecast and when I was speaking in Hong Kong, again, the dollar has a down cycle into summer. After that, longer term, again, we could be looking at another bounce. And most importantly, just like on these dates, there's a very, very important time point coming up. Again, very short term here in May, and then a second very, very important time point in this summer, or part of summer for the U.S. dollar. And both of those points are extremely critical for catching the trader, being able to play the directional movements for the dollar. So I hope that answers your question.
The Hong Kong HSI index, you believe, might be showing some warning signs for us?
Well, yes, exactly. And I sent you a chart, and also there's actually one right now posted on my website dated April 23rd. So I put that up on my website, Gold2020Forecast.com. But specifically, what we talk about in there is I show a historic cycle, and based on time. What I'm looking at right now for the Hong Kong stock index is a pretty substantial correction or a drop. Again, cycles don't give exact price points, but they do give direction. And so the Hong Kong stock index should have been topped, or should have topped today into early part of this coming week. And then I would expect a reversal and a pretty sharp drop straight down. And with that type of an energy on the markets, I would expect, the other markets, U.S. and everything else to follow suit, to the downside. It's just, the Hong Kong is far more overbought, so it's far higher. So I think the drop looking at the Bollinger Bands, the Hong Kong stock market drop should be substantially more than that of the U.S. markets.
What about in China itself? I heard that the stock market was so hot that 1.5 million new stock accounts were being created every week, and that they had a shortage of stockbrokers to take the orders.
Yeah, well, and this is even the funnier part. In the article that I posted on my website, and I found the link on on I think Hedge, or forget the actual website, but somebody sent me a link, and it was really amazing. The actual housewives are now trading in the Hong Kong stock market. And then another client had sent off something about there's apparently like they're leveraging. You can leverage now accounts up to like 20 to 1 or something like that. So yeah, it's just getting insane. And so, and then looking at what I'm looking at for regard to cycles, it's extremely dangerous right now in terms of even days, not even weeks, forget weeks, just days, for the Hong Kong market right now. So, next week's not looking real good, and, we'll see what happens here. But, I think, we're really at a critical juncture here. Just, when we work with cycles, there's specific, counts that I look at in terms of days, and, we're definitely at a very crucial junction here for the Hong Kong markets.
And Bo, if Hong Kong does collapse here in Vancouver, I'm sure we would hear the screams and yells from across the ocean.
Well, exactly, because all the markets are tied at the hip, and so some just move more than others. Like the DAX has been rolling over for a few days already, so it's not as powerful. If you look at Germany, but Germany's been doing very, very well. It's been moving up, but now it's been rolling over slowly. It hasn't done anything, but it's been slowly coming over. The U.S. markets are pushing up again, but again, they're still sitting in the 1800 range. I specifically right now see a huge danger sign for Hong Kong. And so, and then when I do my index counts or my day counts for the, U.S. markets, again, I've got down cycles for all of those coming up here too. But then when I run the Bollinger Bands, the Bollinger Bands are enormously stretched, when we look at, Hong Kong versus markets like the U.S., you won't have as much of a drop. And then Canada is a little more stretched, I think, than the U.S. So again, you're right, Vancouver, it's just every market should be having a significant pullback here very, very shortly. And then again, that would account, like we were talking about the U.S. dollar, I believe, when you sell a market, instinctively you're actually you have to buy the dollar because it's the opposite trade. So that would be, I believe, a reason for a short-term dollar rally that we spoke about earlier.
And on the Dow, what's your short, mid, and long-term outlook there?
Well, still, I've got long-term. I have a 242-year count that basically puts in a cycle low, a dramatic cycle low in the year 2016. It's a very specific time point I have for that. I also have a very specific time point this summer for the stock market. Again, very critical time points. And so long-term still is down. Medium-term, we're going to see right now, short-term, again, like we talked with Hong Kong, we're still looking for a short-term, not looking good. Medium-term might get a bit of a bounce. And then long-term, again, still down. So, it just continues into 2016. There's nothing safe in the U.S. or world markets until 2016. Again, there's a very specific time point for all of this. So it's a very specific time point for the Dow, for the dollar, and for gold.
And what about the S&P and NASDAQ? Any difference in the numbers there?
Honestly, I look at the markets as a whole. For the U.S. markets, I do have price points that I give to my subscribers yesterday for potential targets for short-term drops on the Dow and on the S&P. But again, when one falls, so will the other. On
gold and silver, once major moves start to happen with those, what's going to move first, and what kind of action do you expect to see with that? I believe gold will first move in reaction. It should bounce the first, but silver will be right behind it and then catching up very, very quickly. But I do see positive energy to the upside. Cycles should be turning upwards here very, very shortly for both gold and silver. I think it's really important to remember, and everybody, maybe is forgotten or have a tendency to forget. But 4 to 6 months ago, the CME came out with some very specific guidelines
for gold and for silver, should something happen where, they have breaks in that I think it's like if silver moves more than $3, they can shut the breakers go off for like 5 minutes, and then they can open up again, and then and then it runs again, and then they can hit the breakers, or the breakers get hit up to 4 times. And so if, there were, I think it's for $3 or $4 silver moves, and I think it was for $100 or $150 gold moves. So, it's really, really important to remember that those are there for a reason. And, when I was in Hong Kong, I was basically very specifically speaking about, price action for gold and silver, which is going to be up into summer. We're not at summer yet. And, again, there's a very specific time point coming up this, before into summer. Very critical to be able to play this move, because when the volatility hits, I think it's going to be extremely crazy. But again, if you have cycle time points, just like right now we're looking at, for the equity markets, we're looking at potentially, this is a key time point right here. And if the markets turn, again, it illustrates how cycles, are very, can predict cycle turns very, quite accurately. And, so to answer your question, into summer, we're still looking for a very specific time point and upwards directions for the metals, both gold and silver. And I believe silver is going to be the absolute winner, hands down, into the top.
Do you think silver gets ignored because its price is so much lower than gold?
No, I think silver is the one that's manipulated the most. And right now, it's the last one to go, or last one to get to the bottom. But it's the one that's literally manipulated the most, from terms of manipulation price or pricing points, pushed down, hated the most. But on the opposite side of the trade, it becomes the one that's loved the most at the same time too, when price goes up. And looking right now, we're, in the 70-to-1 ratio, which is crazy. The ratio, within the world, when you mine gold, from what I've learned and understand, is in the vicinity of about 10-to-1. So for every ounce of gold you mine, you typically would mine 10 ounces of silver. Right now we're 70-to-1. Typically, those ratios, like a 10-to-1 ratio, are crazy ratios, and, they are hit at time points. But right now at a 70-to-1, if you believe in precious metals, I think the one to buy is silver, just because of the crazy ratio, of 70-to-1 right now. And when the ratio does approximate, well then definitely you want to look at maybe holding more gold. But right now, just because of the substantially high ratio price, gold relative to gold to silver ratio, I would absolutely be focusing in on silver.
Bo, if a person was to get your newsletter, how can they do that, and what could they expect to find in it?
The most critical thing that I can tell you, and as I mentioned even today, is timing. People talk about, I listen to other people speak, and they say, they give you price points, but more important than price point is time. And so what we give in our forecast is timing. So when to look for what. And so that would be key. So right now we're looking for a cycle high here on the equity markets, with a turn. And we expect, the Hong Kong, but basically the equity markets to be rolling over. When it was IDs of March, we were saying, okay, that right here in the middle of March, I think we did an interview there too, we call specifically, this is a critical cycle point, and gold should be making a critical bottom right here. Well, if you remember that interview, Jim, we basically, we nailed that spot in time as gold was right at 1141, 1145, right in that range.
Within a couple of hours.
Right. Well, right. It was right there. And then we specifically, we did an interview on the day specifically because I knew that was a timing point. That was a reversal. And also that was a critical time point for the U.S. dollar. So the U.S. dollar at that time critically, hit a 100.70 or something, and then it dropped. But that was a key inflection point or turn point for both of those, entities. for gold and then for the U.S. dollar. So what we offer in our in our service is timing points. So you don't have, so price becomes less important. If the Hong Kong or the U.S. dollar, or if the Dow or the S&P or the HSI move up a little higher or lower, it's less important in terms of the price than to know how long something should be going downwards or how long something should be going upwards. And so what we offer again is timing. And so if people are looking for, when is the dollar, like we're saying, we're looking at bounce for the dollar right now. Well, we actually have a specific day into the near-term future where the dollar again is going to top and then reverse. Okay, and likely we're similarly for the stock index and also for the for gold, we're looking at their specific turn points. And because of the volatility that's about to hit our world, it's becoming very, very critical to know the when versus just the price. Because if you know the when, you can actually navigate through these crazy waters that are about to hit.
Bo, thanks a lot for chatting with us.
Sure, my pleasure. And again, my website, if anybody wants to get a little more information, I think we'll even have this interview posted up there. But it'll be gold2020forecast@aol.com.
Coming up, CanadianInsider.com's Ted Dixon on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Ted Dixon, CEO of InkResearch.com. Welcome to the show, Ted.
Great to be back, Jim.
Well, you always have what's brewing with the insiders. Well, the insiders' view on energy right now.
We're seeing in the energy space a little bit of a switch. What we've got coming up at the end of the month, and we'll be announcing it in the second Friday of May, is the rebalancing of the Inc. Canadian Insider Index. It's an index we launched in November of last year. It tracks the 50 growth and value stocks preferred by insiders, and your listeners can track that index in real time, by the way, at CanadianInsider.com during the trading day. And what we've got coming up is this 6-month rebalancing of the index, where we make sure that the stocks that are the most preferred by insiders are captured by the process to identify the members of the index. And what we're seeing leading up to that is a subtle shift in the energy area. Notably, when we did the last rebalancing in November, there was a big tilt towards pipelines and more conservative types of names. Well, we're seeing a little subtle shift now towards the exploration names, which gives us some confidence, or a bit more confidence anyways, that the lows that we saw in December may hold in January in the energy stock space. Now, that doesn't mean to say that these lows cannot be retested. They could. And doesn't necessarily mean that we're in for an extension of this rally that we've had in the energy space. But it does provide some confirmation that a lot of shakeout has happened and that maybe the worst is over. And I do stress the word maybe, because this is a subtle shift we're seeing. It's encouraging. The energy sector is a big part of the Canadian market. So it's nice to see at least that insiders are starting to tiptoe back into the exploration area in terms of where their sentiment is lying. It gives us some confidence, as I said, that maybe the worst is over, and that at least people can start looking longer term, that maybe we're building a base here for recovery. That's it. I don't want to make it sound like the flags are waving for a massive continuation of the bull market run. We're not quite picking that up, but we are seeing a subtle shift towards better confidence in the exploration development side.
Is that good news for the service sector in the energy business?
Well, they've been doing fairly well in terms of the stock price recovery as well, and we have seen some insider buying in those names. So selected service companies that are well positioned seem to be seeing some insider buying. But again, I don't want to get too far ahead here to say that this is a massive recovery, and I do believe in the sector area it's pretty stock specific, so it'd be important to look at those companies that have the right equipment for the times. And whereas 12 months ago The service companies were in high demand. I think it's going to be a little bit more selective. It depends on where they're positioned. So service companies are definitely, they've been benefiting from the recovery here, but I think the selectivity is going to be the key for investors going forward.
Right. The pumps and the pipelines still have to be looked after.
That's right, and there's still drilling going on, and exploration companies need to drill to generate cash flow to pay the bills. So it's not like there's been a big halt to energy exploration or development, but there's been a cutback in the growth plans of these companies. So sort of the marginal service players will feel the heat, whereas those with the technology to help exploration companies meet their cash flow needs. So, yeah, it's good to see that maybe we're forming a base here, but the real kind of test will be, I think, after the spring breakup, as we go through the traditional kind of cyclical downturn in the industry that you see every season, and we'll see how the oil and gas stocks how they behave in that usually a week period. If they continue to build on their momentum during what is usually a week period in the spring, early summer, then that could be a good sign. But I would, just see what happens here and see how insiders respond. If the stocks do continue to run in the summer and in the spring, and insiders are continuing to buy, that would be a good sign. But if you see insiders selling in May, then that may be a good sign to go away.
The old saying, sell in May, go away. Have you seen a shift in insider sentiment?
In the broad Canadian market, it's cooling off a little bit, but there's two different, I would say, situations going on in the Canadian market. We're seeing a little bit of frothiness in what we call the HITS area, the healthcare, industrial, technology sectors, which have had a good run. So we're seeing quite a bit of profit taking in the technology sector. So we've actually got that sector as an overvalued reading based off of our indicators. That does not mean the sector cannot continue to have momentum. It just means that the valuations at this point are stretched, and that if you are investing in that sector, really you should be aware that you're investing in momentum plays, and it's going to be hard to spot some value in that sector. So there is some profit taking going on. Insiders are being much more cautious. The hit sectors, the hit sector stocks, they've done quite well, especially after the Bank of Canada rate cut. And what we're seeing, though, is the enthusiasm in some areas that maybe have lagged a little bit, notably the mining area. We're seeing increased insider activity there. Stocks that have not benefited as well from the current monetary environment. These companies seem to be attracting some insider bids, ones that have lagged the market. Again, that suggests that there's value there. It doesn't necessarily mean there's going to be a huge rally. However, we have to keep in mind that the Bank of Canada is flooding the system with liquidity. That is the preferred avenue for that liquidity to run down has been housing and real estate. Whether that continues to be the case, it's impossible to predict. There are signs that outside of Toronto and Vancouver that the housing plays are cooling off a bit. We will see. But that money that the Bank of Canada is pumping into the system will go somewhere, and it wouldn't surprise me to see some of it go into the stock market, in the Canadian market, which really has been viewed as not the place to be. Everyone 6 months ago was talking about investing in the United States, the U.S. market, and yeah, certainly in Canadian dollar terms, the U.S. market's done very well, but in local currency terms, Canadian stocks have actually outperformed U.S. stocks year to date. The Canadian Insider Index is up almost 6% year to date, and some of the broader U.S. indices are, around 1 or 2, despite the headlines you hear about the Nasdaq hitting an all-time high. Basically, the Canadian market has done better than the U.S. market year to date. So, with the Bank of Canada keeping rates low and making sure that we don't enjoy the benefits of a high Canadian dollar as consumers, the people have to be cognizant that that favors assets because the Bank of Canada is flooding the market with liquidity, and liquidity has to go somewhere. The question is which assets. So insiders right now are taking some profits in the technology area, and they're building positions in the mining area.
We're speaking with Ted Dixon, CEO of InkResearch.com. Ted, are people still looking at trying to defend the money that they've made, or are they switching now to maybe riskier investments with the idea of making more money instead of just saving money?
To answer that, I have to, again, go back to what insiders are doing, and I'm going to focus in on what we're seeing as a trend leading up to the rebalancing of the Canadian Insider Index. This index, by the way, is tracked by an ETF called the Horizons Canadian Insider Index ETF. It's HII on the Toronto Stock Exchange. And what we're going to be doing in the middle of May is announcing the rebalancing, the 6-month rebalancing of this index. And what we're seeing is a slight shift away from defensive financials, notably REITs. And again, as I was mentioning earlier before the break, these are subtle shifts. So I don't want to leave the impression that there's sort of a sea change going on in the market, but there's some encouraging signs that insiders are getting a little bit more bullish on the economy. They're building positions, as we mentioned before the break, in mining, and they're also seem to be taking a little bit of money away from the REITs. So the REITs are more of a traditional defensive play, low interest rate play, which leads me to kind of think, well, maybe insiders are starting to signal we've seen a bottom in long-term rates. I think it's a little too early to say that that's with a high degree of confidence that that's what we've seen, but the 10-year Canadian government bond was down around, I think almost down to 1.3% this year, maybe even lower than that. It's depending on, how quick you were looking at your terminal. But the yields have bounced back a bit. We'll see if that's the case. If that were to continue, if long-term rates were to continue, certainly REITs would not benefit from that situation. We are seeing a little shy away from the REITs from the insiders. So that, it's an important trend to watch, I think. And on the other side, as we mentioned, a little bit more investment in the mining, and we're also seeing continued enthusiasm in the industrials area. We just had a federal budget that came out, put more money into the auto sector. Again, we have a central bank that's determined to try and devalue our way to prosperity. That seems to be the philosophy of the central bank. It's not my philosophy, but it is what it is, and there are winners and losers under that approach. The winners would be companies, profits of industrial exporters. So, for those Canadians who are consumers, which means all of us, we don't win under a lower Canadian dollar, but there are areas of the economy that do win. You probably want to consider having some exposure to those areas, just because as a consumer, if the Canadian dollar keeps falling, we're going to have to keep paying more for everyday things that we need, food and other imported items. And also, as imports become more expensive, local retailers can also try and put up their prices. So, or will have to put up their prices if they're importing goods. So it's a double-edged sword, and insiders are feeling pretty upbeat in terms of the industrials and maybe some of the more economically sensitive areas of the economy. So over the long term, that's probably good. But on the other side of the coin, those who have been relying on the ongoing rally in the bond market, definitely that's worth keeping an eye on to see if we've maybe run a course in that. People have been declaring the death of the bond market rally for many years now, and it's never happened. So I'm not about to say insiders are signaling that. It is just interesting that they're kind of pulling away from the REITs, and this is the first time we've seen that in quite a while. When we had the big taper tantrum a couple of years ago, when Ben Bernanke, as Fed chair, mused about ending of QE, REITs got hammered. Everyone was afraid that the long-term rates were going to be soaring. When that didn't happen, there was insiders, were piling back into the REITs well before the REITs recovered. So it's interesting to see that seems to be a little shift away from the REITs right now. We'll have to see if that continues.
Ted, thank you very much for chatting with us.
Well, it's great to be here, and have a great weekend.
My guest has been Ted Dixon, CEO of InkResearch.com. Also, check out his website,
CanadianInsider.com.
After the break, Tim Cyclesman Wood on This Week in Money.
This Week in Money is archived online at TalkDigitalNetwork.com.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome to the show, Tim.
Jim, thanks again for having me.
Let's take a look at the major markets, the Dow, NASDAQ, and S&P. What are your short, medium, and long-term outlooks for those major markets?
Well, Jim, short term, we should be pushing into, there's some cycle tops due now. Intermediate term, there's also some cycle tops due now. We do have short and intermediate term buy signals, but those at the, like I said, short and intermediate term, there should be some cycle tops due. Long term, we again are dealing with the most extended 4-year cycle advance in stock market history, and we've been looking for a setup. I say we've been looking for, it'll try to materialize, but it just won't stick. But once we get, that's what's got me so bearish, is because it's so extended, it's so overdone. For the reasons we talked about in the last show, once this thing sets up, I think there's going to be one heck of a reversion to the mean, and that's what's got me so bearish longer term. It's the setup with those shorter term cycles and the intermediate term cycles that we have to see, though, to cap that longer term advance. And until that setup occurs, it's just going to grind on. And looking at the industrials, I have a chart up in front of me right now. The industrials have gone nowhere in basically 3 months. We have a Dow theory non-confirmation in place. The industrials are struggling. I see that the NASDAQ 100 is at a new post-2009 recovery high today. Obviously the trend there is still positive, it's still up, but again, the same thing applies. We should be at a short and intermediate term top, and then, longer term we're looking for that extended top there. Looking at the transports, they continue to lag. They're in the red just a little bit here. So our Dow theory non-confirmation continues to warn of possibly something bigger trying to develop.
And with the downturn in the price of oil, I know a lot of the rail transport over the past year has been oil tankers on the railway. Well, if you have less production, there's going to be less activity there. That would mean the transports would be getting flat, wouldn't it? Or even go down.
Well, I don't even look at I don't look at things like that. I look at the cycles. I mean, I follow the logic, and logically, yes. But I look at, just the charts, and so what I'm seeing, looking at it, speaking at it from a cyclical perspective, I don't know what oil is doing specifically today, because I'm in a hotel and on the road traveling on some family stuff. But oil had made an intermediate degree bottom in March, which we knew, so we have short and intermediate term buy signals on oil. And the same thing is kind of true as with equities. I mean, we have a short-term top due, but I think that within the context of oil, we have a longer-term, I say longer-term, an intermediate-term advance underway. Ultimately, I think that the intermediate-term advance is a counter-trend move within the context of some longer-term broken cycles, if you will, and that ultimately longer-term oil is going to move lower, but we have this intermediate-term advance correction, if you will, in the longer-term downtrend underway, and we should be at or near a short-term top there as well.
I know previously you said $30 oil could happen if things just didn't turn out the right way. Are we still looking at a possibility of $54 oil dropping into the 30s again?
Yes, after this counter-trend rally, yes, because, that is a statistical I guess you'd say, fact in looking at the relationship that I look at to come up with that number, and it has not been fulfilled. And like I said, nothing moves in a straight line. It ebbs and flows, and it's no surprise to me. I didn't expect us to go straight to that point. Like I said, I knew that we were approaching the intermediate term, and in my world, there's an annual cycle as well, those lows. And that's all we're seeing, I think, is the bounce out of those lows. And then once this counter trend intermediate degree advance has run its course, then I think we're back on track to look for those numbers.
What are your projections using cycles for gold and silver?
Gold is also, I don't look at silver as often, but gold, it longer term is broken. The 9-year cycle is still moving down. It topped in 2011. We have further to go. Intermediate term, we have a low in place, and there's been an intermediate term rally underway in gold, and I see no indication. I see no indication at this point that rally has run its course. The intermediate term low occurred back in March. So far, the structure is positive at that intermediate degree. Short term, we should be at at or near a short-term low, in which gold should bounce out of that low, and the intermediate term advance should continue. And so it's kind of like on the same path with crude oil. It's a bounce within the context of a longer-term decline, I believe.
What about consumable commodities like the grains?
I have to be honest, I have not looked at any of those specifics recently, but I can tell you from looking at the CRB index, which is I do look at, it is moving pretty much like, and that's just, let me back up for a second. The CRB is just a basket of commodities that make up the index. And looking at the CRB, there is a 3-year cycle that ebbs and flows. And within that cycle, you have an annual cycle, an intermediate degree cycle. I mean, there's cycles of various degrees, and some of them are moving up, some of them are moving down, and that's what gives you the zigzags on a chart when you look at it. But looking at the CRB, we had an intermediate degree low, just like with gold and just like with oil in March, and that rally at this point is still underway. And let me say this with something. We've talked before about structure. And so when you move into, let's take commodities or gold. Let's take gold. Let's back up to gold for a second, and let me explain something to the listeners. You have an expectation. And what I mean is you have an intermediate degree low, like I'm looking at a gold chart. Someone wants to pull one up and they can follow this. We have an intermediate degree low let's back up to November. And then we had an intermediate degree low in March. So the intermediate degree bottom occurs. We have the intermediate term buy signal, and the expectation then is, hey, we're going up. And so we're going up because we know we had the intermediate degree low. We have timing bands. We know when that low is expected. We have the DNA markers for the low. We get the buy signal, and up it goes. So that sets our expectation. And we know that it's a bounce within the longer-term broken cycles. So we know it's counter-trend. We know it's going to reverse. But when does it reverse? When does it turn? Well, it turns when the shorter-term cycle fails. You look at the structure. I always talk about structure. And you look at the structure of that cycle, right translation versus left translation. And I know that may sound a little confusing. It's really simple. The shorter-term cycles, are they moving up for a longer term, longer duration than they're moving down? And in other words, are they peaking to the right of the center of the cycle or to the left of the center of the cycle? So you look at that structure. And so while our longer-term or intermediate-term expectation for gold is up, if we get this low that we're fishing for now, it should be coming into a low now. If we get that low, and then all of a sudden you get a failed cycle advance of a lesser degree or left translated, even if it was to move on to a new high, if it becomes left translated, then boom, the cycle's turn. That's part of the turning. And at that point, then the intermediate term cycle has turned down. And so right now with commodities, we have not seen that structural signature to tell us that the intermediate term advance is broken. So we have to assume until we see evidence that it has broken, that it's still intact. Now, that's not a cop-out. It could fail, next week, or we get confirmation it goes on next week. Ideally, we should have a multi-month rally underway. But because we know it's a counter-trend rally, it's the kind of thing that, we're dancing close to the door, and we're looking for those left translations in commodities because we know it's coming. And when it does, then I think all the commodities turn back down.
Tim, are we also in an area where a lot of cycles are starting to coincide with each other? So if we do have a downturn, it could hit a number of sectors at exactly the same time?
We actually do. It's interesting you say that. We actually do, because and part of it depends on when they turn, how right or left translated they are. But if this, for example, if this intermediate term cycle that's underway, intermediate term advance that's underway in commodities was to fail sooner rather than later, then it would line us up for a lot more weakness because of the left translation of the other cycles. And then looking at equities, we have a 4-year cycle, the longest extension ever of a 4-year cycle. And let's be clear, the reason that has happened is not because we're in a secular bull market. And bull market is not a function, people think it's a function of price. And it's much, 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 much more. It's not born of price. It's a secular bull market is born of a sound, fundamental, economy that has legs, that has a basis. These higher prices has nothing to do with any kind of sound fundamentals. It's all about liquidity. And so what I'm saying is that it's phony in that respect, and it's a secular bear market. So what they've done is we have this long extended 4-year cycle, longest in stock market history. And then we have the shorter term annual cycle, we have the intermediate term cycle, and then we have even the shorter term, monthly cycles that I look at, all converging. And so every time they converge into a top, that's an opportunity for the longer term stuff to turn. What you have to do is monitor the structure of those lower degree turns as a hint of the higher degree, because you'll see it first with the lower degree based on the way they set up. That's part of those DNA markers. That's part of the setup. It's part of it. And so that's what we're monitoring. But absolutely, and when the tide turns, so to speak, and all those cycles line up, that's when it's going to be bunker time. And I maintain that when that happens with equities, that it's going to make the decline in 2007 and 8 and into the 9 low look like a Sunday picnic, I believe, because of the conditions in which the rally has occurred and the degree that it's been extended.
And they gave the title for the 2008 drop, The Great Recession.
Yeah, well, this may be the Great, Great Depression, because you just can't do the things they do. It's not sustainable. It's not real. And it's not going to last, and the outcome is not going to be good.
Tim, thank you very much for chatting with us.
Jim, thank you once again for having me.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Well, that wraps up our show for this week. We'd like to thank our guests Bo Polny, Ted Dixon, and Tim Cyclesman Wood. And thank you for listening. Comments or questions for This Week in Money can be emailed to info@howstreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
This Week in Money is a production of How Street Media Incorporated.